Hello everyone and welcome back to these sessions on Advanced Strategic Financial Management. Friends, in this class we will be continuing with the topic Advanced Capital Budgeting, and for today's class what I have decided to discuss is effect of inflation on capital budgeting decisions. Now what happens, you are taking a long-term investment decision, correct? Capital budgeting is all about long-term investment decision. And then you are spending the initial investment at the initial stage, correct? And you are expecting the cash inflows over the coming years throughout the life of the asset or throughout the life of the project. Now, can't we agree that inflation is a factor that cannot be ignored? Because what would happen, what is something that can be acquired for X amount today will be available for 2x amount after certain number of years, and the only factor that can bring this is inflation prevailing in the economy. Our economy, as you can see, it is an inflationary economy. Every growing economy will be inflationary economy by default, because your focus is on growth. You will eventually come across facing inflation. If you can recollect, we have looked into the inflation effect even in the forex topic, and now we are focusing completely on effect of inflation in your investment decisions or capital budgeting decisions. Now what precaution we need to consider? So when you are making estimates of future cash flows, the future cash flow estimates could be the cash flow estimates based on the prices that are prevailing now, or these could be the cash flow estimates based on the prices prevailing then. For example, if I tell you that every year I expect 100 students in one particular batch of final CA or final CMA in my class. If the batch size is 100 students multiplied by say 15,000 as fees per student, my revenue per batch will be 100 students multiplied by 15,000. Now I am making a budget for next 5 years. Over the next 5 years, as per my policy, I will take only 100 students in a batch. But the price, the fees that I charge may not remain the same. That means if I am making the budget based on the fees prevailing now, it is the cash flow estimates based on the current price level, that is cash flow estimates without accommodating inflation. Then such cash flows derived out of such estimates are called real cash flows, and these are inflation-free cash flows in real terms, or simply real cash flows. On the other side, if I say something like say calculator, it is priced as rupees 400 now, the same calculator will be priced as 420 after 1 year. Same calculator, same model, same company, and as such the demand and supply of calculator also does not have major impact. But just because of the general price level rising in the economy, the price of the calculator has increased from 400 to 420, indicating around 5% inflation. So because of inflation, the price of one of your products has gone up, and you need to accommodate these price changes or these changes in inflows and outflows or incomes and expenditures based on the inflation that you are expecting in the economy. So what I'll do is, to explain you the complete impact of inflation, I will get started with one small example. I will derive various values through that example, and then I'll come forward with definition of various terms that we are drawing out of that particular example. Before I start with that example, just let me explain one simple thing. For example, in our economy, if you suppose go to a bank and make a deposit, say a term deposit, a fixed deposit, what bank will give you? around 6 to 7% interest for 1 year. That is the current scenario in India, correct? Now, in India, the average inflation rate is also around 6 to 7%. So when you are making a deposit with a bank, bank is not actually giving you any income in the form of any interest income. You are actually earning nothing. What bank is doing for you is it is compensating the effect of inflation, because if you deposit say 100 rupees with the bank, 100 rupees will become 106 in 1 year's time. But what you can purchase for rupees 100 now, because of inflation, the same thing will be purchasable at 106 after 1 year. So as such, your money grow only to such an extent that it can compensate inflation, means actually you have not earned anything. In such an economy, how would an investor expect a rate of return which has inflation adjustment? That is what we are going to focus on. So please carefully look into this particular example, and I will give you a couple of minutes to note down this example. First of all, what is mentioned over here? You want to invest rupees 1 lakh today for 1 year. Pure interest rate that you expect equals to 10% per annum. Inflation rate equals to 8% per annum. What will be the inflation adjusted interest rate that you need to earn? So please write up this example and then I take you ahead. Alright friends, once you have written this example, let me explain how should you approach this. Let us first imagine that there is no inflation prevailing in the economy. In that case, if you are investing 1 lakh today and you expect a return of 10%, the amount of cash flow that you would expect after 1 year will be 1 lakh plus 10%, that is 1 lakh 10,000, correct? 1 lakh 10,000 will be the expected cash flow after 1 year without considering inflation. Now, what would be the effect of inflation? Whatever is the value today, for example, if it is 1 lakh today, forget about interest element. Just because of this inflation rate of 8%, what can be purchased today for 1 lakh, the same commodity, the same goods, the same asset will be available not at 1 lakh after 1 year, but after considering 8% inflation, it will be purchased at rupees 1 lakh 8,000 after 1 year. So 1 lakh becomes 1 lakh 8,000 just because of this inflation rate. What I am trying to tell you is, if in this example somebody says that okay, you give me 1 lakh, I give you 1 lakh 8,000 after 1 year, the counterparty is just compensating you for inflation. You are not earning anything at all. Now on top of that, if you need to earn 10%, it is on 1 lakh 8,000 that you add 10%. Then only you will be earning in real terms 10% pure interest or 10% real interest. So what you need to do is, you need to first make interest adjustment to arrive at the future cash flow based on the prices prevailing today, then make inflation adjustment to arrive at the inflation adjusted cash flow. So let us look into how to do the same over here. So here what you need to do is, you get started with the initial investment of rupees 1 lakh. At the first stage, ignore inflation and just consider the interest that you would want to earn, that is 10%. On 1 lakh of present value, you add 10% interest to arrive at the expected future value or the expected future cash flow. 1 lakh plus 10% will be the future cash flow that you would want to earn without considering inflation. That will be 1 lakh plus 10%, that is 1 lakh 10,000. That will be called real cash flow. Then real cash flow means the amount of future cash flow without considering inflation adjustment. Then you add 8% inflation rate to such an amount to arrive at the inflation adjusted cash flow. The inflation adjusted cash flow is called nominal cash flow or money cash flow. So let me show you how to put up the calculations. Here you may write the heading as total monetary value of future cash flows, and what you do is you get started with the principal amount invested, that is rupees 1 lakh, add interest at 10% per annum. Now this is the pure interest rate that you would want to earn, that is 10%. So without any impact of inflation, 1 lakh of today should become 1,10,000 after 1 year. That is what you want to have. Now, given that in the economy the inflation rate is 8%, so without inflation the amount of 1,10,000 would have been sufficient inflow in your hand after 1 year, because it would represent 10% returns. But knowing that the value of money is going to decline because of inflation, you need to earn a little more to compensate this inflation. As a result, 8% you can directly add on 1,10,000, that would give you 8,800, and adding the inflation adjustment, total monetary value to be received after 1 year with inflation adjustment will be this 1,10,000 plus 8,800, and that would give you 1,18,800. So effectively the rate of return that you need to earn, how will you compute this? You have invested 1 lakh and the maturity value with inflation adjustment what you want is 1,18,800. So simply take the calculation as 1,18,800 minus 1 lakh divided by 1 lakh, multiply by 100 if you want the final result in percentage, and that gives you 18.8% per annum. So please write up this entire calculation and then I take you ahead. Alright friends, once you have completed writing this entire calculation, let me just go with a little bit of analysis over here. As I have told you earlier that this is the present value of the money that you have invested. First you adjust the return that you want to earn, that is 10% return you adjust. This is the real interest that you want to earn, and therefore this should be the real cash flow that you must obtain after 1 year free from inflation. So present value and real cash flow, the gap is the time value of money, whereas this is real cash flow, that is cash flow based on the current price level. This is also the future cash flow but called as a money cash flow, which means inflation adjusted cash flow. So the gap between the inflation adjusted cash flow and real cash flow is the inflation. So you know, from the present value to this inflation adjusted future cash flow, you are carrying out typically two adjustments. One is the adjustment for time value of money, which is indicated by the real interest rate, and another adjustment is the inflation adjustment. Now, two types of cash flows we will be considering. One is what we call as real cash flow, one is what we call as nominal cash flow. Real cash flow indicates the future cash flows, but which are based on the current price level, that is the prices prevailing now will be the basis for assessing or estimating these cash flows. However, the inflation adjusted cash flows will be the nominal cash flows or money cash flows. So in an inflationary economy, the money cash flow will always be greater than the real cash flow, because real cash flow is free from inflation. On the other side, the money cash flow or nominal cash flow is the inflation adjusted cash flow. So you be very clear, three values we have to consider: the present value, then the real cash flow, and then the nominal cash flow. The gap between the present value and real cash flow is purely because of time value of money. The gap between the real cash flow and the nominal cash flow is the inflation adjustment, and therefore the gap between the nominal cash flow and the current value of the money will be indicating the interest rate, which is inflation adjusted. So keep in mind one thing very clear, because these terminology should not confuse you. We have present value, then future cash flows. We have not one type of future cash flow. We have two types of future cash flows. One is what we call as real cash flow without any effect of inflation, and one is what we call as inflation adjusted cash flow or nominal cash flow. So present value, real cash flow, nominal cash flow. Real cash flow, nominal cash flow, both are future cash flows. What is the difference between these two? The difference between these two is purely the inflation adjustment. Real cash flow is free from inflation. The nominal cash flow or the money cash flow is inflation adjusted cash flow. On the other side, the present value is simply the present value. Now guys, in this example, 10%, which is the pure interest rate that the investor wants to earn, this becomes an expected rate of return without considering inflation. This is called real discounting rate. 8% in this example is the inflation rate, and what we computed at the end, that is 18.8%, the effective interest, which makes 1 lakh of present value converted into the inflation adjusted cash flow or the money cash flow. That 18.8% is the inflation adjusted interest rate, which becomes the nominal discounting rate or money discounting rate. Now use your simple common sense. The future cash flow in this example are two different future cash flow amounts. 1,10,000, which is the real cash flow, 1,18,800, which is the nominal cash flow. Now you discount 1,18,800, considering the discounting rate of 18.8%, you will land up at 1 lakh. You discount the future cash flow, which is real cash flow, that is 1,10,000, by the real discounting rate of 10%, you will land up again at 1 lakh only. So the gap between 1 lakh and 1,10,000 is the real discounting rate as time value of money, and the gap between 1 lakh and 1,18,800 is the nominal discounting rate, which is inflation adjusted discounting rate, or you can call it as money discounting rate. Money discounting rate or nominal discounting rate are just two different terms that we can use for resembling the same thing. So what I want you all to do is, the whole matter that I have discussed with you in the analytical way, I would want you to note it down systematically. Based on what we have just discussed, please write, from the above example, the following conclusions can be drawn. Rupees 1,10,000 is future cash flow without adjustment of inflation. This is called real cash flow, in short RCF. Rupees 1,18,800 is future cash flow with adjustment of inflation. This is called money cash flow, that is MCF, or nominal cash flow. Real cash flows are future cash flows which are based on prices prevailing today. Money cash flows are future cash flows based on prices prevailing then. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. To discount the future cash flows into present values, a discounting rate is required. For discounting the real cash flows, the discounting rate to be used is known as real discounting rate, that is RDR. For discounting the money cash flows, the discounting rate to be used is known as money discounting rate or MDR. Present value of RCF using RDR will be same as the present value of MCF using MDR. So please write up this entire thing and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. In order to convert RCF into MCF, the inflation factor to be multiplied will be 1 plus I raised to n, where I indicates inflation rate and n indicates the number of years. In order to convert MCF into RCF, the inflation factor to be multiplied will be 1 plus I raised to minus n. So you can either consider the factor as 1 plus I raised to minus n or 1 divided by 1 plus I raised to n. Both will have same implications. So write up these couple of points and then I take you ahead. Alright friends, once you have completed these points, let us move ahead and discuss something important. In the example that was just concluded, the discounting rate for money cash flows will be the money discounting rate, which was the inflation adjusted discounting rate, or you can also call it inflation adjusted interest rate. So whatever was inflation adjusted interest rate becomes the discounting rate for nominal cash flows or money cash flows, and therefore it is known as nominal discounting rate or money discounting rate, in short MDR. This was 18.8% in this example. The real discounting rate, which indicates the real rate of interest, which is 10% per annum in this case. Now RDR will be considered for discounting the real cash flows into their present values, and MDR will be used for discounting the money cash flows into their present values. Now, inflation rate was 8%. Now try to understand one thing. These two rates were given, and through that actually we have derived MDR. You remember that example and the calculations that we made. That was the base of this entire discussion. How did we arrive at this 18.8%? Through the information about the real interest rate and the inflation rate, or you may call it real discounting rate and the inflation rate. Now, if we formulate a simple equation like this, you get the same value actually. Let me show it to you. MDR, that is money discounting rate, can be 1 plus 0.1. So now this 1 plus 0.1 is actually 1 plus the real discounting rate. So 1 plus 0.1 would become 1.1. So please pick your calculator. Even I have picked it in my hand. 1.1 multiplied by 1 plus inflation rate, that is 1 plus 0.08, that would give you 1.08. So by calculation it is 1.1 multiplied by 1.08. So when I do that, what I get is 1.188. What does that indicate? The future value of 1 rupee after considering real interest rate of 10% and inflation rate of 8%, the future value of 1 rupee would become 1.188. That means when you multiply 1.1 into 1.08, what you will get as a result is 1.188. But that is the future value of 1 rupee. So if you subtract that 1 rupee, you will be getting the money discounting rate. So let us subtract 1 from that, and what I am getting on my calculator is 0.188, which is nothing but indication of 18.8%. Now, if we focus on this particular equation, what we can conclude is you can compute MDR directly by making this approach for calculation. 1 plus RDR, that was 1.1 in this case, into 1 plus inflation rate, that was 1.08, and from that you subtract 1. So once you get this equation, you can shift this minus 1 to the left hand side, and what you get is 1 plus MDR equals to 1 plus RDR into 1 plus inflation rate. This is the base equation. Now through this equation you can derive anything. For example, if RDR and inflation rate is given to you, you may compute MDR. If MDR and RDR is given to you, you can compute the inflation rate. And if MDR and inflation rate is given to you, you may compute RDR. So let us write up these calculations. So 1 plus RDR will be 1 plus MDR divided by 1 plus inflation rate. So RDR will be 1 plus MDR divided by 1 plus inflation rate minus 1. And if you want to compute inflation rate, it will be 1 plus MDR divided by 1 plus RDR minus 1. So please don't just copy this, understand and write it down. This is something very, very important. Alright friends, once you have completed writing this whole thing, let us move ahead and learn how to apply these concepts in calculative examples, starting with question number 33. It says, annual cash flow in real terms it is rupees 10,000 per annum. Now be careful about the wordings used over here. Real terms means these are real cash flows. Inflation rate is given as 10% per annum. Discounting rate for real cash flow is given as 20% per annum. Life of the project is 4 years. You are required to calculate money cash flows at end of each year. So keep in mind one thing, real cash flows are given to you, inflation rate is given to you. So through this you may apply the inflation factors and compute the money cash flows from this information. Money discounting rate. So for computing money discounting rate, what all we need is the inflation rate information along with the real discounting rate. Yes, both are available. We can easily compute the money discounting rate. Present value of money cash flows using MDR and present value of real cash flows using RDR. Now one thing is very clear. For real cash flows, it is 10,000 per annum. Every year same amount of cash flow and the real discounting rate is given as 20%. You may apply annuity factor at 20% for 4 years on 10,000. You will be getting the present value of annuity, which will indicate the present value of real cash flow using RDR. But when you compute the present value of money cash flow using MDR, keep in mind one thing, neither money cash flows were given in the question nor money discounting rate was given in the question. For computing these two, you need to take the support of this inflation that is prevailing, that is 10% per annum. So more or less we have understood what has to be done in this particular question. So let us look into how to present the solution. In your solution, you first go for computation of MCF. Now please carefully understand one thing. We have been given the real cash flows for the 4 years of project life and each year real cash flows are same. Now we know one thing, that the inflation factor that should be multiplied to the real cash flows will be 1 plus I raised to n, where n will be indicating number of years and I indicates the inflation rate. In our example, I, that is inflation rate, is given as 10%. So it will be 1 plus 0.1 raised to 1 for first year, raised to 2 for second year, and so on. So these are the inflation factors that we get, and the real cash flows multiplied to the respective inflation factors would give you the respective amount of money cash flows over 4 years life. Now computing money discounting rate, we have learned this equation a few minutes back. MDR will be 1 plus RDR into 1 plus inflation rate minus 1. So that will be 1 plus 0.2 into 1 plus 0.1 minus 1. That will be 0.32 or 32%. So please write up this entire calculation and then I take you ahead. Alright friends, once you have completed writing these calculations, let us move ahead and continue writing further. We are now going to compute the present value of MCF using MDR. So through the earlier workings, we have already computed the money cash flows for each of the 4 years, and we have also derived the money discounting rate, that is 32%. So the present value factors at 32, when you plot, you multiply the money cash flows to the respective present value factors to get the present value of money cash flows, and the aggregate of this comes to 25,887. If we try computing the present value of RCF using RDR, now RCF indicates real cash flows, RDR indicates the real discounting rate. Real cash flows were given in the question directly as 10,000 per annum for 4 years. RDR, real discounting rate, was also given in the question as 20%, and because the real cash flows are in uniformity, you can apply the annuity factor. So PV of an annuity at 20% for 4 years will give you 2.588735. When multiplied to real cash flow per annum amounting to 10,000, the total present value of real cash flow would come to 25,887, which is matching with the present value of money cash flows determined using the money discounting rate. So please write up this entire calculation and that will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question. That will be question number 34. Let us read this question. Life of the project given as 4 years. Inflation rate is given as 8% per annum. Money discounting rate is given as 25% per annum. Expected money cash flows are 20,000, 24,000, 26,000 and 28,000 respectively for 4 years. You are required to calculate real cash flows for 4 years, real discounting rate, present value of money cash flows using MDR and present value of real cash flows using RDR. Now in this question again there is nothing odd. You can easily make the computations because money cash flows have been given and inflation rate is available. So what you will do is 1 plus 8% raised to minus n will become the inflation factor that will convert the money cash flows to real cash flows, because these are inflation adjusted cash flows, right? These are the cash flows based on the prices prevailing in future. We want to find the future cash flows based on the prices prevailing now, which is the indication of real cash flow. So you can divide each of these by 1 plus I raised to n or multiply each of these by 1 plus I raised to minus n. Both will give you same effect, you know it, and you will be able to compute the real cash flow. Then for computing real discounting rate, we need the input as the money discounting rate or nominal discounting rate along with inflation rate. That also is available, and these two calculations at the end, that is computing present value of MCF using MDR and present value of RCF using RDR, can be determined easily once the basic calculations are made. So let us move ahead and look into how to present the solution. So we first compute RCF from the given information about MCF. So you plot the MCF values that were given to you, and 1 divided by 1 plus I raised to n will be the inflation factor. So inflation rate is 8%, so it will be 1 divided by 1.08. Keep on pressing equal to, you will be getting all these inflation factors for 4 years. Because this is 1 plus I raised to minus n or 1 divided by 1 plus I raised to n, you can directly multiply these factors to MCF and you will be getting the RCF. But keep in mind one thing, when you have computed the RCF, this is not the present value. RCF itself indicates the future cash flows based on the prices prevailing now. So when you compute RDR, what you do is you take 1 plus money discounting rate divided by 1 plus inflation rate, and from that ratio you subtract 1 to get the real discounting rate. So the calculation goes this way: 1 plus 0.25, 25% was the nominal discounting rate or money discounting rate, 8% was the inflation rate. So 1.25 divided by 1.08 minus 1 will give you the real discounting rate, that will be 15.74%. So please write up these calculations and then I take you ahead. Alright friends, once you have completed writing this all calculation, let us move ahead and now compute the present value of MCF using MDR. So in the question, the money cash flows were directly given to you, money discounting rate was given to you, so you can easily compute the present value of money cash flows using MDR. This total comes to 56,141. So write up this calculation and then I take you ahead. Alright friends, after computing the present value of money cash flows using money discounting rate, let us move ahead and now we compute the present value of real cash flows using the real discounting rate. Now in the question, the information about real cash flow wasn't there. We have computed the real cash flows through the information about nominal cash flows and inflation rate informed in the question. We have only determined this real discounting rate through the information about money discounting rate and inflation rate. So now let us apply 15.74% discounting rate and check what is the present value of real cash flows do we get, and what we are getting as 56,141 is same as the present value of money cash flows discounted using money discounting rate. So please write up this whole thing, and that will be end of the solution. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question, that is question number 35. One of the question asked in past exams. KLM Limited requires rupees 15 lakhs for a new project. Useful life of project is 3 years. Salvage value is nil. Depreciation is rupees 5 lakhs per annum. So basically 15 lakhs is the cost of the project. 3 years life, salvage value nil. So it was implied that depreciation will be 5 lakh per annum using straight line method. Given below are projected revenues and cost excluding depreciation. That means the cost informed to you does not include depreciation. Fine. And this is ignoring inflation. Now be careful about this. When I say that these revenues and costs are ignoring inflation, means they are not inflation adjusted cash flows. These are the cash flows based on prices prevailing now. In simple words, these are indications of real cash flows. Further given in the question, applicable tax rate is 35%. Assume cost of capital to be 14% after tax. The inflation rates for revenues and costs are as under. Now look at one thing. First of all, inflation rates for revenue and costs are different. That means you have different inflation rates for inflows and outflows. Secondly, each year the inflation rates are different. Now what happens? Assume that inflation rate was 9% static every year. Then you know what you would have done for computing inflation factor? You would have taken this as 1 plus 9%, that is 1.09, raised to 1 for first year, raised to 2 for second year, raised to 3 for third year. But now we cannot do that. What we will have to do is, suppose it is inflation factor for the second year, you generally would have taken 1 plus I raised to n, that is 1 plus I raised to 2. Here you cannot raise to 2 because you have different inflation rates for the 2 years. So for the second year, the inflation factor will be 1 plus 9% multiplied by 1 plus 8%. In other words, 1 plus I1, that is inflation rate for the first year, into 1 plus I2, that is inflation rate for second year. Likewise, when you come to year 3, the inflation factor for the third year will be 1.09 into 1.08 into 1.06. And similarly, you will make application for the inflation factors with respect to cost as well. Now look at one thing. The question has given you PV factors at 14% for 3 years. They have given after tax cost of capital to be 14%. That means what you will do is, these are revenues and costs without inflation adjustment. So inflation adjustment will have to be made. In other words, you will convert the real cash flows into money cash flows. Keep in mind one thing, inflation cannot affect component like depreciation, because depreciation is a cost which is based on historical cost. Inflation cannot affect depreciation. And these PV factors already given in the question means it is implied that this 14% discounting rate what they have given is inflation adjusted discounting rate, or it is the nominal discounting rate or money discounting rate. Show the calculation in rupee, that is in nearest rupee, and NPV of the project has to be computed. So basically the only different thing what I am finding in this particular question is the inflation rates for revenue and costs are different, and inflation rate is not static for each year. Inflation rate is varying year after year. So let us look into how to present the solution. In your solution, you first write up this working. Year 1, 2 and 3, the real cash inflows are given to you. Inflation factors will be 1.09 for first year, 1.09 into 1.08 for second year, 1.09 into 1.08 into 1.06 for third year. Please keep in mind one thing, what we generally do all the time, it is 1 plus inflation rate raised to 1, 1 plus inflation rate raised to 2, 1 plus inflation rate raised to 3. But that we do when the inflation rates are same. Here inflation rates are varying, therefore you need to apply inflation factors like this. These inflation factors when multiplied to the real cash inflows, what you will get is the money cash inflow. So once you compute money cash inflow, using the same logic, you will convert the real cash outflows into money cash outflows. The inflation factor for outflows will be different. So money cash outflows have been identified. Now look at one thing. These are money cash outflows. So these are costs which do not include depreciation. First of all, depreciation cannot be an outflow because it is a non-cash expense. It will be considered for computing your profit, but will be eventually added back after adjustment of tax. You know that thing. I don't have to explain you. So quickly write up these workings and then I take you ahead. Alright friends, once you have completed this working, let us move ahead, and what we now do is we make the computation for the 3 years, starting with the money cash inflow, which indicates your revenue. So basically the question has given you the real cash revenue, correct? Now we have converted that into money cash revenue. In other words, these are revenues which are inflation adjusted cash flows, which are money cash flows. Similarly, the money cash outflows, which indicate the cost in cash terms, we have identified that as well. So inflow minus outflow will give you the net cash flow, that is the cash flow before tax, or you can also call it net income before tax and depreciation. So you know, profit before depreciation and tax or cash flow before tax are one and the same, because depreciation is a non-cash expense. So this comes to the amount of net income before depreciation, subtract the amount of depreciation, that will be 5 lakhs every year. What you get is the taxable income, or you can call it profit before tax. Subtract tax at 35%, compute the amount of tax at 35% on the profit before tax, obtain the amount of profits after tax, and once you get this, you add back depreciation and you will be getting the annual cash flow after tax, which will indicate the net money cash flow. So net money cash flow means inflow minus outflow, that too after the tax adjustment. So we finally got the inflation adjusted net cash flows for each of the 3 years of project life. So please write up this entire working and then I take you ahead. Alright friends, once you have completed this entire working, let us move ahead, and what we now do is we make calculation of NPV. So we take year 1, 2 and 3, we just write up the net money cash flows that we have computed in the earlier working. The present value factors at 14% inflation adjusted discounting rate was already informed in the question. Apply the PV factors and you get the present value of money cash flow. Take the total of the same, that is the total PV of money cash flows on net basis. Subtract the outflow, which is the cost of the project, and what you get is the resulting NPV. Some people may also call this as inflation adjusted NPV. That means this is not NPV based on the real cash flows, this is NPV based on the money cash flow. Now because it is present value, you have already given effect of inflation while discounting. Keep in mind one thing, the discounting rate was money discounting rate, means it was inflation adjusted discounting rate. That is why the inflation adjusted cash flows have been discounted using this rate to arrive at net present value in today's terms. So please write up this entire calculation and that will be end of this solution. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question, that will be question number 36. Let us read this question. Cost of the project is rupees 5 lakhs. Internal rate of return for real cash flows is 15%. Real cash flows increase constantly at 25% of previous year's real cash flows, and the inflation rate is 10%. That means there is a growth in the real cash flow by 25% each year, and inflation rate is 10%. Calculate the nominal cash flows for 5 years, assuming that the life of the project is also 5 years. Now, how would you solve this question? I would suggest you that first pick this information, that internal rate of return is given as 15%. You know one thing for sure, that if you consider the discounting rate matching with the IRR, the NPV will be 0. In other words, the present value of inflow will match with the present value of outflow, and present value of outflow is already known. So what we can do, we can assume the real cash flow in the first year, say, to be X rupees, and then we constantly keep increasing the real cash flow each year by 25%. We can plot the real cash flows based on X values for 5 years, and then you can convert these into present values using the real discounting rate, which is IRR, and in that case the present value of the real cash flow would match with the cost of the project, that is 5 lakhs, because IRR and discounting rate being same, the resulting NPV will be 0, that is PV of inflow will be same as PV of outflow. You will be able to formulate the equation and you will be able to compute the value of X. Once you get X value, which represent the real cash flow in the first year, what you can then do is compute the real cash flow for each year, and then after applying inflation adjustment, you can determine the nominal cash flow or money cash flow for each year. So please look into how to present the solution. In your solution, you first mention that IRR of the project, that is 15%, which is based on real cash flows, which is given as information in the question. Now also write the fact that if IRR is used as discounting rate, that is 15%, NPV of the project will be 0. In other words, it indicates that the total PV of inflow will be same as total PV of outflow. Real cash flows increase constantly at 25% every year. So we will say, let the real cash flow for the first year be X. Write up this description and then I take you ahead. Alright friends, once you have completed writing this description, let us move ahead, and now what we do is we go for calculation of PV of RCF using RDR, that is taking RDR as matching with IRR of 15%. So you plot the table. Year 1, 2, 3, 4, 5, we have assumed that the cash flow in the first year to be X. That is the real cash flow in the first year to be X. Each year cash flows will increase by 25%. So what was X in the first year becomes 1.25X in the second year, and that becomes 1.5625X in the third year, and so on. Don't just copy these figures, keep adding 25% and check it yourself. Then we have PV factors at 15% discounting rate. Keep in mind one thing, this 15% discounting rate is for the real cash flow, and that represents the IRR of the project. And when you multiply the real cash flows with the PV factors, you'll be getting the PV of the real cash flows. Because real cash flows were in X terms, the present value also comes in X terms. When you take the total of PV of RCF, I have rounded off to just 6 places after decimal over here at the end, and that is the total PV of real cash inflow, which must match with the PV of outflow, because the discounting rate what is picked over here is same as IRR. So just write below this table that at IRR the PV of cash inflow will be equal to PV of cash outflow. Now PV of cash inflow is this amount what we obtained, and PV of cash outflow is given as rupees 5 lakhs in the question. When you apply this calculation, you can get the value of X. Once you get the value of X, you just go on adding 25% each year to get all these cash flow values. And when you consider the inflation factors using inflation rate of 10% and multiply those inflation factors on the real cash flows, you will be able to compute the money cash flows for each of the 5 years. But before we do that, write up this entire working quickly. Alright friends, once you have computed and written this whole thing, which I am sure you are not just copying the figures, you are supposed to make all these calculations, and once you are done and clear with this, let us move ahead. And what we will do is we'll compute the money cash flows. So just plot a simple table over here. The years 1, 2, 3, 4, 5. The first year real cash flow we have computed as 96,661. Each year go on adding 25% and you get all these real cash flows. Now these are real cash flows. We need to still find the inflation adjusted cash flows, that is money cash flow. And for this purpose, the inflation rate given to you is 10%. So inflation factors for each of the 5 years you can plot by taking 1.1 raised to 1 raised to 2 raised to 3 and so on. Then when you multiply the real cash flows with the inflation factors, you will be getting the money cash flows for each year. Once again I am telling you, don't blindly copy everything. Make sure that you are calculating each and every figure and then only noting it down. Once you finish writing this whole thing, it will be end of the solution as well as end of this class.